Traders, ladies and gentlemen, welcome. Something very serious for you today, something that's been affecting all of us, the cost of living, more commonly known as inflation. Now, before we begin this incredible session, let's take just no more than 10 seconds to get real here. Yeah, it's all well and good watching YouTube videos on trading that are entertaining and a bit of fun, but there comes a time when we all actually have to start doing some work. And that's why we're here today. If you're serious about your trading and you want to see just how much work institutional traders such as myself who do this for a living put into this, well then, the fun needs to stop and the work needs to begin, right? You're all capable of doing it, but like I said, you need to set aside serious time away from looking at most of the irrelevant random line nonsense on these channels and start spending some time doing some serious work. If you're not willing to do that, well, then trading isn't the right business for you. The good news is we're actually going to do that together right now. So if you're serious about your trading, you're in the right place, let's go. Okay, so the way I want to start today, probably best just to have a quick recap of where we were last time that I did some institutional analysis. Things have changed quite a bit. So it's nice for us to have a baseline scenario. Obviously, I'm going to be flicking around with slides a lot, and there's some amazing graphs you're going to see that you won't see anywhere else, including information, institutional information. But it's nice for us to have a base, right? A baseline for us to start from, as in where things are at the moment relative to where they've been earlier in the year. Things were starting to get pretty bad. If you remember the last institutional analysis I did, we were down around 5% in the market. We're now down 18%. Okay, so very, very different scenario. Why is that? Let's have a look at that. So some of the things that were negative last time, in particular inflation, now very negative. Okay, so that's obviously had a downside impact on the market. Commodity prices we thought appeared to be near a peak. That isn't the case. They've continued to rise with the Ukraine situation and rhetoric from Russia obviously increasing. And then this week, as we saw, one of the biggest down days in around 2 years, minus 4%, which we're going to have a look at, corporate earnings, right, obviously were caused a lot of nervousness in the market. So generally, if we just kind of recap, some of these things have stayed in the right places that you want them to be in, like the economic fundamentals have been fairly stable, but some of the more kind of geopolitical factors and in particular inflation have persistently been high and started to get more negative, as we're about to see. Obviously headline numbers reaching 8%. So really, it is all about inflation. You know, we can go into all of these individually. Obviously, I want to keep this quite short, and it is about inflation today. And point is, inflation has really shifted to this side, okay? And I think it's had the biggest impact on the markets. Obviously, commodities drive inflation. And let's actually have a look at the impact it's had on the markets. Inflation really shifting towards the bearish side. Let's go and have a look. So you can see here, you may have seen this before, but it cannot be denied. And I'm going to keep making the point because a lot of people saying, you're going to see, we're going to talk about equity markets a lot here. So when I said before we're down 5% and we're down now 18%, yeah, I'm talking about equity markets, but who cares? Let's have a look. Proof's in the pudding. Don't need to take my word for it. Crypto market down just as much, right? So the black line is the S&P, which to me is the most important market because it reflects the economic health of a country, because, or in this particular circumstance, the US, because at the end of the day, if companies are doing poorly, why is that? Because the consumer is not spending money, right? Or they have other pressures on their margins, which ultimately is going to lead to a spillover into the general economy. So for me, the equity market is the most important, but it doesn't matter because it drives everything else. And we see that Bitcoin down, right? You see other markets here as well. Things like dollar yen down, completely crushed since the start of the month. So this is the whole month, 1 month. Very negative, right? The market is all markets. So just because I'm talking about equity market, it doesn't matter. If you trade FX and you're not looking at the stuff I'm showing you today, you've got to ask yourself if you're actually serious about trading. Probably not. Get serious today, right? Some of the other things, treasury rates, obviously crude oil has, and we know, stayed fairly supported, and because of the war and the rhetoric from Russia, and obviously it's helped the market stay fairly supported geopolitically, being driven. Slight disparity with the other markets, but the point is every other market has been completely hammered. So any market you're trading, this is really important. Let's actually have a look now in a little bit more detail at the markets. I'm going to equity market, but like I said, it impacts everything. Let's go and have a look at that. So what we have here is the equity market, but I'm looking from a broader perspective, right? So if you think about the other things we just looked at, this is the last month, right? And obviously this is the fundamental situation. Now I want to broaden it out a little bit, just so you can get your bearings a little bit as to what's actually happened over the year. Well, like I said, absolutely hammered, right? Over the month, I think we're down around 5%, but over the year, we're down like 18% now, okay? So very, very negative start to the year. I think it's one of the worst starts the market's had in around 50, 60 years, right? So something you need to pay attention to, okay? And what we can actually do now is we can put a different perspective on it. I just want to give you a perspective as to just how much the market is different this year to how it was last year, and even the last institutional analysis I did, just how much the market has moved and shifted, as we said in the first slide, towards negative sentiment, right? So like I said, all the items you see here, a lot of them are shifted down more negatively, and like it says here, negative skew equals a negative market. So I want to show you how important these things are to be aware of, because these are the things that are driving the market negatively, right? And we can see that reflected here, but also here. Look at the drawdowns in the market. We're down, as I said before, around 18% this year. This is really just to give you some perspective. What does it mean to be down 18%? Well, historically, the market has accepted 20% to be a bear market. Okay, so we're not quite there yet. So that's why this 20%, at least psychologically, is a very important number. We can see here in 2012, we didn't quite make it. We're going to have a look in a moment at 2018, 2019. This is where we had a big recovery, right? We got down to minus 20%, and then the market just, boom, rallied to new highs. Obviously, during the COVID scenario as well, we were actually in bear market territory, and then we had a huge rally back up to new highs. We're going to look at those two scenarios in a moment. Really, really important. So just to get your bearings, look where we are right now. Can you see? Very, very precarious position. Down minus 18%. Very close to bear market territory. And just finally, you can see what I've put here for you. I promised you information you're not going to see anywhere else, especially collated in this way. Look at the number of days of corrections we've had in 2022 relative to 2021. What that means is 10% is kind of widely accepted as correction territory. How many days in 2021 did we have in correction territory? 0, right? The entire time. The market didn't even correct once. How many days have we had this year? 32 days already, right? And we're not even halfway through the year. That means we've spent a long period of time in correction territory, okay? So it's very crucial sort of point that we're at right now. If you think about it, will we continue to stay in correction territory and then recover? Or will we continue to stay in correction territory and then actually get worse into a bear market? So you can see why these things we looked at on the first slide are so important, because if they continue to be negative, that's obviously going to have a very negative impact on markets. So let's actually have a look at some more details, right? Let's actually do some digging. Remember all what I said at the start? You have to do some work at some point. It's nice to just watch videos about trading, but at some point you have to do some work. So let's do that. Let's actually start digging down and try and understand what happened last week. What actually caused us to have one of the biggest down days, minus 4% in 2 years last week? What was it? Was it fundamentals? Was it something else? We need to do that, right? No one's going to tell us that, okay? I mean, who's going to give us the answers? You know, if you want to make money, obviously you've got to think outside the box and do work for yourself, and that's how you get rewarded, right? So let's do that work. Let's actually have a look at last week. What was the standout event last week in the markets? Retail sales, right? And that was on Tuesday. Actually came in very, very positive for the market. So what I noticed, retail sales came in very, very positive. Despite that, the market seemed to just ignore it. Next day, absolutely hammered, right? So yeah, it did have a slightly, obviously we had a positive day on the Tuesday when the number was actually released, but look how quickly market sentiment changed just several hours later, right? The market absolutely tanked. And you can see here the market bugged. What I mean by that, something was bugging the market, right? So this is where I think it became quite apparent, not only to me as an institutional trader, and obviously institutional traders are the ones driving these markets, all other institutional traders I think recognized that actually, you know, the market isn't really reacting as one would expect to strong fundamental data. Something's bugging it. What is that? That's where you need to start thinking about, well, what else was there last week, or what's actually been quite persistent in recent history. So one of the things that, and the topic of today is obviously inflation. If you think about it, one of the most persistent factors that has been not only worse the whole year, but getting worse and worse, is inflation. Okay, so clearly inflation, and corporate earnings were there last week, but they were more inflation related, and you're going to see what I mean by that in a moment. I think it's dawning on a lot of people just how important inflation is going to be for the direction of markets and just the economy in general, right? It's all, I won't say 100% down to inflation, but I would say it's at the forefront of every institutional investor's mind now, because it is so persistent. And we're going to have a look at some of that and why. So you see here, why does inflation matter to markets? You're going to see a little bit of that in the next few minutes. I'm not going to spend too long, but enough that it's going to be stuff you don't really tend to see in the commercial space. So one of the things I said I wanted to look at, if you remember the chart from the start where I said, you know, we're down 18%, we're going to look at this in a little bit more detail. So what do I mean by that? So where did I say that? Here, you know, I said we were very close to bear market territory in 2019, and we had a big recovery. We were then below, as in actually in bear market territory in 2020 during COVID, and then we had a big recovery again. Obviously here in 2019 we didn't quite make it. Why was that? You know, this is where you need to ask these questions. Why was that? You need to start digging deeper, right? So let's have a look at those scenarios. This is the 2020 scenario, right? Down 30% in bear market territory. This is a 2018 scenario, down 20%, not quite going into bear market territory. And look now where we are, minus 20%. So, you know, this is what institutional investors and traders are doing all the time. They're trying to find comparables, right? So that, can we compare it? Can we compare it? Why did we have a big recovery here? Why did we have a big recovery here? Are we going to see the same? Is there evidence to suggest we're going to see the same? And that comes back to why inflation is so important to the market. Because one of the things that drove this recovery, right, back to all-time highs and then back to all-time highs here, and I'm going to keep flicking between these charts because it is important. Do you remember this? See that? Back to all-time highs, down 33%, back to all-time highs. It's this. It's exactly this, right? You see that? Down 33%, back to all-time highs. Down 20%, back to all-time highs. Now down 20%. Everyone's asking the question, are we going to go back to all-time highs? Well, why did it happen? Right? That's the first thing you need to be asking yourself. And I say this all the time, but forgive me, it's true. Nothing to do with no ridiculous Fibonacci or random squiggly line on your chart, okay? That, and I say it all the time, it's true, right? Any child can draw that stuff. Complete nonsense. Nothing to do with that. It's the Federal Reserve. You can see it. Fed indicates an end to its tightening cycle. Here, Fed steps in and provides lower rates. So basically, the same effect, right? The tightening cycle is ending in both of these scenarios, and the Fed is starting to reverse a lot of that. So is it likely here that not necessarily that the Fed will reverse, but that it will calm down the recent kind of hawkishness we've seen. The rhetoric from the Fed recently has been, and we can see that here, here you can see interest rates have been rising, and the market expectation is what? That the Federal Reserve is going to continue to hike rates. Why is the Fed hiking rates, right? And this is the key to this, answering this question. Why does inflation matter to markets? Because the Fed has a target, right? It's not necessarily, they stopped having a physical target. So if you look at, I did warn you we're going to be flicking around a little bit here because, you know, markets are complicated. We need to make sure we're on top of all sorts of information. You know, the Fed has had a target in the past. You know, we all know about 2% inflation rates and targets, and central banks like to keep it at those levels, but it no longer has a fixed target, but it does have a mandate to keep prices under control. So if you look now, inflation is rampant, right? It's completely out of control. So this is concerning the Fed. So the trouble is, the Fed is now in a position where it can't react in the same way it has previously when markets have collapsed, right? That's the point. When markets have tanked and gone to bear market territory, which we see here, just to highlight that again, here and here, the Fed is not in a position that it was in those times, because look where inflation was here and here. It was much lower, right? It was like 2-3%, right? I can show you that, and that's why it's important to look at all the data. See that? 2%, right? The Fed was able to be much looser with monetary policy. The difficulty right now is its hands are tied. It's being forced, partly because it got so loose and left rates so low for too long, in my opinion, during 2021. Obviously, we came out of the COVID crisis and they just kept leaving rates low, right? It puzzled everyone. I talked a lot about this in my Institutional Sundays from last year. In 2022, they're now having to catch up, right? And that's what's worrying the market. So can you see the hands are kind of tied in the sense that they're reliant on where inflation falls, right? So it's kind of out of their hands. Why do I say it's out of their hands? Because Jerome Powell made a good point in the last inflation meeting. He kind of said, look, we can't control supply side inflation, right? Supply side inflation. Our job, or we are more in control of demand side inflation. So this is another problem that we have at this moment in time, and why I talked about the earnings, you know, being a factor this week, about the 4% down day. A couple of things and then we're done. Is a lot of this inflation is being driven. The reason I'm saying this is because we need to now come to some conclusion, right? We need to wrap this up now and make a decision. You know, ultimately, what's going to cause the market to rally? It's the Fed not necessarily lowering rates, but not being as aggressive as the market thinks they're going to be. Okay, so people are kind of expecting 3% rates, right, potentially over the next few months. That's what's worrying investors right now. You know, if the Fed can be getting more towards normalization of policy around 2%, you see, so this expectation in the market can drop. That's what's going to help the market rally. Okay, and the only way the Fed is going to do this is how? A drop in this rate. Inflation, where are we? Here. Okay, so can you see now why I've made this all about inflation? Hopefully you can see. If this rate does not drop, I think it's going to be very hard for the equity market to have any sustainable recovery. Even if over the next week or two, yeah, we are over, you know, I wouldn't say oversold, but in a way, yeah, we are oversold. You know, historically, we are at a big correction territory here. So it wouldn't surprise me to see some recovery, but to see a sustained recovery is my point. And that's the question you should be asking yourself as an investor, whether you're trading equities, whether you're trading FX, it doesn't matter. Are we going to see a sustained, are we just going to see a little correction and then continue to collapse, which I think will happen if inflation persists at these rates, because the Fed will have to hike rates aggressively, right? And Powell said it this week. I think is another reason why the market got so spooked is he said, look, our hands are tied. If inflation persists, we're going to be aggressive. He's made that clear to the market, and I think that's why the market is trying to force their hand a little bit. But for us to anyway see this sustained recovery upwards, we're going to have to see inflation come off. Okay, so that's ultimately what you need to ask yourself is, do you think inflation can come off? Part of the issue we have, right, and it's one of the, just on the supply side issue, is inflation is being driven by the supply side. So what do I mean by that? Commodity prices, right? The supply of commodities into the market, the supply of goods and services into the market. If you look at some of the earnings that came out this week, Walmart, Target, and one of the reasons why we had such a negative performance in the market, where are we gone on this particular day? Sorry, I'm flicking around a lot. I will find it. There we go. You see this -4%, massive day down. It's because of obviously Walmart, Target. They came out and they actually said it's unit costs, it's their cost, the supply side. They're not so alarmed by consumer yet, the demand side. The supply side has had a negative effect. So what the market has done is hammering these companies now. If you look, consumer discretionary, consumer staples, they're being completely hammered, right? Because what's actually happening is the market's thinking, hang on, fine, that's all well and good, it being the supply side. But if this persists and it can't come down, then it's going to start affecting the consumer eventually. So that's the point, and let's wrap it up now. Really nice way to conclude is let's have a look at different scenarios, okay? You saw that where I put those percentages. This is why these graphs are so important. 8%, right? That's the extreme case. If we stay in that, you could even put 8% here. If you saw that little graph I had of inflation that pops up to 8% where we are currently, if it continues there, look, Fed must continue to move aggressively all year. It's likely that we're going to see, we may see some of the economy flirting with recession in the US. That's going to be bad for the equity market. I don't think we're going to see a recovery anytime soon. If inflation can drop off slightly and the Fed at the next meeting in June, I think it's a 50 basis point hike. It's a done deal in a couple of weeks' time, middle of next month. They may pause or only hike 25 basis points the meeting after, or they may just do nothing in that meeting and take a break if we start to see inflation start to come off a little bit. Okay, so that could be fairly positive. Obviously, the best scenario would be that the supply side issues, so geopolitical issues, do start to come off. Now, the thing that actually worries me is this, okay, and this is the final slide that we have, is can you see what I've written here? Ukraine, the reasons why we've had persistent inflation are things like Ukraine-Russia war, recent China lockdowns, price of oil. Does the Fed control those factors? No, it can. When we see demand side inflation, i.e. where too many people chasing too few goods, of which there is a little bit of that, obviously after the COVID bottleneck ended, the Fed can manage that. Put rates up, make it more expensive for people to borrow, and demand comes down. Here, the Fed can't, the Fed is not the oil market. It can't force oil prices to go down. The Fed is not Russia, and we've seen that, right? Obviously, Putin's in charge there. So they can't control that situation. What if these, and that's the risk to me. This is what you've got to be watching. If oil continues to go up, if the lockdowns in China don't calm down, because don't forget, a lot of people get their goods manufactured in China, a lot of these American companies and global companies, and then if Ukraine war gets worse, I think we're in for a rough ride. Okay, so can you see how important the inflation picture is? And just finally, how can you actually trade this or make sure that you're trading this in the right way? Well, one of the things I like to do, and I've said this before, is the sentiment is obviously very negative, right? So I want to make sure that my trading reflects that, right? So you can see last week, and this is the final thing, these are the short trades I took last week. So this is my short performance, including commissions, obviously. you can see here, longs and shorts, okay? Let's have a look at the percentages. So last week, fairly solid week, just under $10,000 on the short side, and you can see all the stats, okay? I don't care too much for headline numbers. It's easy for anyone to give these. Got to dig deeper. So you'll see all the risk statistics and you can look at that in your own time. But these are shorts and these are longs. And I'm saying to you, sentiment is very negative right now, and there's a lot of things to worry about, especially on the supply side of inflation. Does that reflect in my trading? Well, I believe it does. You can see there around 85 to 90% of my profits have come on the short side last week, and very peanuts, 10-15% on the long side. Just playing a little bit of recovery scalps. Okay, so that is reflected in that. So these are the sort of things you need to be asking yourself about your trading. And just finally, one thing, just getting, it's all free, right? Getting free value here, so why not look at it? Credit spreads, okay? You can see credit spreads, in particular the CDS market, which is the cost of protection for bonds, has risen, okay? Look at the correlation between that and the market. Very, very important. Can you see here? Because I just wanted to diversify a little bit because I talked a lot about inflation. But look here, credit spreads were quite positive last time. And I'm not going to get into any sort of detail because I know I've overwhelmed you with a lot of information today. But I just wanted to diversify a little bit and just show you just how much worry there is in the market. You can see credit spreads are shooting up. So obviously that is a factor to consider. Okay, so I know there might have been stuff there you may never have seen before or you found overwhelming. Well, you shouldn't feel that way because anybody is capable of understanding it. The point is, as I said at the start of this video, at some point you have to start doing the hard work, and that means weaning yourself off the random garbage being shown in the commercial space. That's just Netflix style entertainment. Today, you've just seen how wildly different the stuff people who actually do this seriously for a living are looking at. So look, you're wondering what to do next. The best thing you can do for your trading career is to watch this video next, where I actually go into intricate details about how you can actually start making trading a reality.